Hey guys, this is Johan with the Fire Relay Team. And in this video, I want to talk about short-term rentals in Detroit. And that's not Detroit and surrounding areas. That's specifically in Detroit. There's been a bit of noise around this, and it's really caught my attention, our attention specifically, because it's working. So I want to do a case study on a property, actually a client's property that they bought a while ago, and it's working really well. I'm not going to disclose the property, the person, the owner, or even the location too specifically, because there's no reason to, invade their privacy or even saturate their market. Because there's plenty of opportunities that are almost nearly identical um, in Detroit. So, but the point is to show what these numbers can potentially look like, and and one that actually is performing as well. This isn't theoretical. These are I'm putting in numbers of actual um, income, revenue, and I think you're gonna if you're interested in alternative ideas and you're looking for cash flow and you can't find it. I mean, this is pretty darn good. Remember, short-term rentals is a little more active. However, and I'll get to it towards the end, there's a short-term rental loophole, which if you are not a real estate professional, the short-term rental loophole allows you to do a cost segregation study and do bonus depreciation to offset other active W-2 income. So if you're a doctor making X dollars or an engineer, somebody making money, and you're trying to figure out a way to reduce your W-2 income and taxable income, the short-term rental, you can do a cost segregation on this, and you'll be able to put a pretty good chunk of losses against your taxable income. So, anyways, without further ado, this is the property. You'll see some stuff blurred out. Again, I'm just not showing certain details of this. I got to be quick too. I don't want to make this a long video, but anyways, this is 5 nights at $500 a night here in June. This property's doing well. This client is self-managing. So again, you still have to do a good job, and this client's killing it. Now I actually run the numbers with a property manager in place. This client's numbers are actually way better than this because they're self-managing. But anyways, you can see it. Nice house. They did it. It's cute, right? It's well done. That's my point here. So now to go into AirDNA and look at what this thing's bringing in. You got 94,000 projected income. Well, 93.3, which is about an average daily rate of 500, an occupancy of over 50%. So they got 5 beds, 3.5 bath, and they're putting it at 16 guests is what they're running their numbers on. And the client did verify. This is projected, right? The client actually told us numbers that are higher than this. So again, clients at higher numbers. I'm going to use the lower numbers just because that's how we're going to be estimating them if we're looking at these. And again, I'm also adding in property management. So I put this in. We have a short-term rental calculator. Your Fire Relay Team agent can have this, share this with you, or help you run these numbers. But I put in these numbers: average daily rate 43, 53% occupancy. Purchase price, this is approximately what they paid. I'm not giving away the exact amount, but it's right there. Down payment is 0.20%. Closing costs, repairs and renovation, furniture, amount financed, interest rate, and this is at 6.5. I mean, again, refinance this later. This client probably got a lower interest rate. 30 years, payments per year 12. Property taxes 5,000, insurance 28. Property management, again, I put in 25. This client's got 0. Look what that does to the cash on cash out return. And from 25% to 41%. So if you can pull that off, it certainly doesn't hurt. Again, I'm putting it back in 25%. I got some maintenance costs. Point is, I'm budgeting stuff. $32,000 a year. $2,700 a month. So on a $325,000 house, 24% cash on cash return, and $2,600 a month, $30,000 a year. It takes $135,000 out of pocket to pull this off. This cost segregation I'll get into later. Now I go into the total ROI just to get a little bigger picture. 325,000. I got my monthly rent. I just used what it was. So then, since this number already counts for vacancy, I have a 0 in vacancy down below. Anyways, I put my numbers down here. $125,000 to pull this off, 24% ROI. We come over to what we love to see on the total ROI calculator is the total ROI. So we got our 23.77 in cash flow. You know, I actually did not do here. ARV is 375. This isn't 350. This wasn't a huge sweat equity play. This was more of a just a cash on cash investment play. So that number's not that critical here. Debt pay down. Remember, tenant is paying down your principal. You got 2% ROI there. Tax savings. You got depreciation and interest. You can write off as losses. So your tax savings are 5%. And then your appreciation. I put in 3% appreciation. I want to show you what this market. I went a quarter mile around this particular property. And this is the data that I've got. I've got all the data here in all these subsequent years. I went back 8 years. 94% from 2007 to 2018 went from $31 to $60 per square foot. 2018 to 2019 didn't move. Probably because we went up 94%. So 2022 went up 37%. 2021, 9, 7, 11, and 6% appreciation last year is what this market's seen. So you're talking on a 2,250 square foot house. Prices went from $70,000 to $250,000 average. So our average is 23. If you take out this first 94.0, whatever you want to do, it's 14%. Point is, it's double digits. It's not 3. So that's what these Detroit markets are doing. I don't sell these hard just because sometimes Detroit can be more difficult, but there are people making a lot of freaking money on these houses. So I mean, if I put this thing at 10, which you're going to see for a few years, I mean, look what this does. These numbers, it explodes. Appreciation is 26% on ROI. You could go negative in cash flow and see 26% on appreciation. So no matter what number, let's put on a 5. Just run this at a 5. We got 13% appreciation, 13% ROI on our appreciation. Because why? Because we only put down 20%. But yet we got $400,000, $350,000 that's appreciating at 5%. So that's the leverage of real estate. So anyways, total ROI is 44%. Then you had in cost segregation, which I'll get to next. So short-term rental loophole. If you don't understand cost segregation, there's a video here. I'll link it below. Cost segregation is the study of you get regular depreciation, which is a straight line. You can depreciate the property over 27.5 years. A cost segregation study is you're pulling out items that you can depreciate over 5, 10, and 15 years. And then with accelerated depreciation, you've been allowed to use those 5, 10, and 15 and write them all off in the first year. Layman's terms, you go from a $5,000 write-off to a $25,000 write-off or $50,000 write-off. It's just a bigger year one write-off. That's really all you need to know. So $325,000 purchase. Value of the property, you can't write off the land. Our yield, this is just another variable that you need to understand. It's usually between 20 and 35. I'd use 28%. Allowed. In 2025, currently, you're only allowed to use 40% of the yield, which is what you pull forward. So that you pull forward $80,000, you're only allowed to use 40% of that. Last year it was 60. The year before that it was 80. Now, most people say 2025 is probably going to flip back to 100%, and they'll retro it to the beginning of the year. So, again, say your marginal tax rate is 33%. The cost of study is going to cost you $1,500. At 40%, even if nothing changes, this puts $9,000 back in your pocket. If this is at 100%, which is most people say it's going to do, it puts $25,000 back in your pocket. So say you make $100,000 a year at your W-2 job, and each month they take out $2,100 in taxes. When you go to file your taxes, if you do this cost segregation study and it shows, hey, you have a $25,000 loss here, you can then put that in your taxes and they'll give you a $25,000 refund. And this is complicated. You gotta do some studying just on this topic specifically, but that's how it works. You get $25,000 back. That is a 18% return. Again, if we get the 100. So I put that into the total ROI. And if it's a 40%, total ROI is 50%. And then if we get the 100% bonus, you're at 62%. So these are real numbers. This client is actually saying they're doing better than this. I'm using what AirDNA is showing, and I'm putting a property manager in this. But I think that's pretty attractive. There's a couple other ones that are doing it as well. This is why it really caught my attention. It's a real strategy. So talk to your fire relay team agent. There's a lot of markets that this works, and there's some that don't. So make sure you peg the right property in the right location. But for $135,000 out of pocket on a house like this, you're talking $2,700 a month. Again, these are good numbers. So this can't be your benchmark, right? But the point is, can I find 15% ROI? Even 10, 15, 20, you're doing really good. So hopefully you like that. Feel free to drop any questions. I think I covered everything I wanted to cover here. So if you're interested in getting a search set up for these or running some numbers on something, reach out to your fire relay team agent, or if you don't have one yet, connect at firerelayteam.com, www.firerelayteam.com, and we look forward to working with you.